Well, the rally in U.S. equities is forcing even the most pessimistic sell-side strategists to rethink those positions. Among them, of course, is Piper Sandler's Michael Kantrowitz. He had the gloomiest outlook among his peers. He's now saying, quote, as we think about where the S&P 500 will end in 2023, the year-to-date move makes it difficult for us to continue justifying our year-end target that we published back in January, as large cap market indices have appreciated a lot year to date. I'm thrilled to say that Michael joins us now. And as I understand it, this call is more about what has already happened, the rally that we've already seen, versus you saying that it has your blessing to continue.
Yeah, it's not so much a change in opinion of what's ahead. It's more a reflection of what's happened year to date. And you know, our call for this year was that markets were going to have going to see sharp downside in the second half of the year. It wasn't about the first half. In fact, you know, we had a call for the markets to be more or less range bound. Certainly, they went up a lot more than we expected. And so it was really just a recalibrating for what's happened year to date, rather than a change in forward expectations.
Well, Michael, when you think about what we've seen over the past 7 months or so and the rally that we've seen, how are you thinking about it? A lot of that has, of course, been driven by tech, been driven by artificial intelligence. Do you see that as a sea change when it comes to valuations, fundamentals, or is this just euphoria?
Well, I think it's a little of both. You know, there's certainly companies that are immediately benefiting from this, and there's other companies, and I'd say most of them, that are going to have a benefit that we won't see quite as quickly or too far that investors can really discount. And so, you know, I think that the macro story of lower inflation is getting compounded by the I guess call it a macro story of artificial intelligence at the same time. And so it's just compounding all of these risks getting priced out at the same time that people have now something to look forward to.
Well, when we talk about looking forward, I mean, there are a lot of folks looking at the economic data, Michael. I mean, you can look at least the data we got today and you say, okay, things are great. Backward looking, to be sure. And there has been a parade of people who've come on this program and say, why aren't you paying more attention to the leading economic indicators index and some of the other forward measures that, at least right now, seem to be showing weakness?
Yeah, and I think it's just, you know, a reality. When you look throughout history, there's a perennial focus on lagging economic indicators near the end of a tightening cycle, specifically on employment, and when inflation's a problem, inflation as well. And so, you know, the narrative today that, you know, inflation's coming down and employment's holding in there is the same narrative that pushed the markets to all-time highs in '07. In late 2000, the S&P went back to an all-time high after the Fed stopped raising rates. Same thing happened in the middle of 1990. So, you know, it doesn't really tell us of where things are going, but the behavior that we see today is not unusual in the context of history. And, you know, we certainly don't want to make investment decisions based off of the second quarter's GDP or even whatever claims did this week or last week. Leading indicators are called that for a reason.